she didn't have to worry about money. Jane decided to make a change. She began by cutting back on non-essential expenses, saving as much of her income as possible. She invested wisely, focusing on assets that generated passive income that didn't require her to trade time for money. Slowly but surely, Jane began to build her financial independence. She was still working, but she was no longer living paycheck to paycheck. She had a safety net, a cushion that gave her the freedom to make choices based on what she wanted, not what she needed. Fast forward 10 years, Jane, now in her early 40s, had achieved her goal. She was financially independent. She had enough passive income to cover her living expenses, and she no longer needed to work to survive. She was free to retire early, to spend her time as she pleased. Jane's story may seem extraordinary, but it's not unique. It's the story of anyone who has embraced the principles of the FIRE movement. It's a tale of discipline, of sacrifice, and of a relentless pursuit of financial independence. To summarize, the key points discussed today revolve around the idea of financial independence and early retirement. It requires discipline and sacrifice, cutting back on non-essential expenses and saving as much as possible. It involves investing wisely, focusing on assets that generate passive income. But most importantly, it requires a change in mindset. It's about seeing money not as a means to buy things, but as a tool to buy freedom. It's about understanding the true value of time and the freedom that comes with not having to trade it for money. This is the essence of the FIRE movement. It's not just about retiring early, it's about achieving financial independence, about gaining the freedom to live life on your own terms. Like Jane, you too can embrace the principles of the FIRE movement and embark on a journey towards financial independence and early retirement. After all, the only thing standing between you and your financial freedom is you.
Ever wondered how much you'd need to save to achieve financial independence? The answer lies within the mathematics of a concept known as FIRE, which stands for Financial Independence, Retire Early. The most essential number in your journey to financial independence is calculated by multiplying your annual spend by 25. Notice the emphasis on annual spend, not annual income. This calculation is based on the principle that you need £300 invested for every pound you wish to spend each month in passive income. Hence, your FIRE number is also your monthly spend times 300. This mathematical principle is founded on the 4% safe withdrawal rate, as defined by financial advisor William Bengen. He proposed this rate after analyzing the S&P 500, which typically produces an average of better than 10% growth per year when studied over a period of approximately 30 years. Bengen considered factors such as inflation and market volatility. After studying previous market activity, he concluded that a 4% rate of withdrawal per year would provide for a 30-year sustainable portfolio in the vast majority of cases. So to paint a clearer picture, if your monthly spend is £1,000, then your target for financial independence is 300 times 1,000, or £300,000. Alternatively, if your annual spend is £12,000, your financial independence target is 25 times 12,000, which also equates to £300,000. The first step in planning your financial independence, therefore, lies in understanding your monthly and yearly expenditure. Without this knowledge, it is impossible to take further strides towards your financial freedom. In summary, the mathematics of FIRE revolves around the principle of multiplying your annual spend by 25 or your monthly spend by 300 based on the 4% safe withdrawal rate. Knowing your monthly and annual spend is crucial in determining the amount you need to save to achieve financial independence. Armed with this knowledge, you can then plan your journey towards financial freedom. Remember, the journey to financial independence is not a sprint, but a marathon. Embrace the mathematics of FIRE and take the first step towards your financial independence today.
Good morning, guys. It is 8 a.m. on Wednesday, the 28th of May 2025, and that means that we have completed 3 years and 8 weeks of what will be roughly an 8-year fire experiment, fire journey. Let's have a little look at the market as it stands. So currently just opened and trading at £83.27 near enough. Yesterday's closing point seems to have been up about 1 2/3%, and that appears as if that might continue today. Currently sitting at up 0.5%. There was a little blip there where it showed a much greater rise, but I think that was just initial orders being executed. The value of the portfolio at present, 23,161. Return on investment sitting at 17 2/3%. There are 278 shares in the portfolio, and the average purchase price as it stands £70.77. Now this has changed a little since I last looked at it. I'm not sure how I go about getting rid of this AI analysis thing. Let's just hit the read button and see actually what it says. So a little disclaimer, first of all, keep in mind AI analysis is experimental and Trading 212 does not guarantee its accuracy. Always do your own research or consult a qualified advisor, not an investment, legal or tax advice, so you have to understand that. Very quickly, Vanguard S&P 500 has shown a broadly stable to modestly positive trend over the recent week, with prices consolidating after reaching local highs earlier in the month. Short-term price movement is demonstrating tight fluctuations with some minor pullbacks, while indicators point to momentum having slowed, limited buying power and a lack of immediate trend direction. Some recent softness is evident, with signals such as the relative strength index indicating oversold conditions, while other measures point to a subdued trend. Valuation levels remain moderate considering risk and volatility, with growth and total return figures maintaining the fund's established pace. Profitability measures are steady, supported by a reliable dividend yield, while the overall risk is moderate given historical patterns. Sentiment among traders and investors is generally neutral to slightly positive, with discussions remaining constructive and focused on standard portfolio themes. No negative events or headlines are observed, and social data points to a cautious but optimistic atmosphere among participants. Some mention has been made of broader market research and diversifying away from top performers, suggesting ongoing portfolio adjustment rather than strong conviction in immediate price action. In summary, technical momentum is subdued, fundamentals remain resilient, and sentiment is steady, with no catalysts driving decisive moves currently. Quite frankly, in summary, a lot of waffle and nothing of concern. I'm just kind of scrolling down here a little bit to see what else has changed. Okay, so these little bars here have gone vertical rather than horizontal now. I'm assuming that's yesterday's day's trading. So yesterday you can see there was a high of 83.26, near enough 27. I think that's where we opened at. Well, I suppose it would be. So a low 82, and then you can see for the 52-week range, sitting about the midpoint. There's really nothing more to say about that. There's some figures looking at history, so up about 8% on a year, only up about 8.75% on 3 years ago. Of course, these are based on kind of exactly 3 years ago, but nevertheless, that will be factually right, and up 18% on the past 5 years. I'm a little surprised that it's not more than that, but obviously you get periods where there's volatility, and sometimes that does affect the historical look of things. Okay, let's have a quick look at the notifications. Biggest stocks before earnings: Bank of Montreal, Okta, Heiko, Macy's, Capri Holdings. I don't think I recognise any of those. PDD disappoints. PDD Holdings down 18% after Q1 earnings miss amid US-Canada trade tensions. DJT goes crypto. Trump media soars 8% on rumoured plans to raise $3 billion for crypto investment. And then we have a little bit about upcoming holidays. Let's just have a look at that. So the US were both closed on Monday for either the Spring Bank holiday or Memorial Day, depending on where you are. Switzerland will be closed tomorrow for Ascension Day, and those are our closure days for trading. So nothing to really affect us as things stand at the present time. Monday obviously has passed. This is now Wednesday. So now that we've had a little look at the notifications, I just want to draw your attention to Monzo.
I want a bank that makes money easy.
That sounds perfectly reasonable.
And you are?
We're a bank called Monzo.
Oh.
I want a bank that shows me what I spend instantly.
No problem, just give us a go. See?
Can you make splitting bills easy?
Super easy, check this out.
But it's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on.
Can I talk to a real person 24/7?
Of course.
Even now?
Yep.
Even now?
Anytime.
Can you tell me when I'm running a little low on cash?
We certainly can.
Cool. Can I afford these?
You certainly can't, sorry. Can't afford that either.
That's a real shame.
Not really. Time's up, how'd you get on?
It's a draw.
Can you help me save for my next holiday?
Oh, how about you set up a savings pot in the Monzo app called Barbados, baby?
Thanks for listening, Monzo.
We're all ears.
We can go now.
Rude. You make Monzo Monzo.
Okay, so as mentioned at the bottom of the screen, there is affiliate links in the description, one for Monzo, one for Smarty Mobile. You can probably get yourselves a good deal using those, as well as helping me along with the affiliation. I have no affiliations to Trading 212 other than the fact that that is the platform that I use for my own investment. Yes, you are looking at a practice account here, but that's simply for privacy reasons. Let's go ahead and put in our weekly investment. Oh, that's the wrong one. I should have hit the buy button. My apologies. More caffeine required. If you've been watching the channel or following the journey, you'll know that each week I invest 120 theoretical pounds into the Vanguard S&P 500 exchange traded fund. This morning that's expected to buy us roughly 1.44 shares. It's going to be a market buy. The market is open, and I'm not setting any limits or anything like that. Let's see how it goes. So order placed and executed very quickly. 1.44 shares purchased at 83.20, and I'm just trying to ascertain in my head whether or not these figures have updated. Yes, I think they have, because I see the average purchase price has definitely risen. So that brings the value of the portfolio to 23,200. Return on investment roughly 17.5%, and we have almost 280 shares. So there you go. Actually, just I hadn't mentioned what these red circles are on screen this week. I had previously, but basically what you're looking at, I believe, back here in March, April 2020, you had the COVID dip, followed by the V-shaped recovery. And as I had said in previous episodes, I believe we're looking at the same thing again now. You've got the Trump tariff dip, and then followed by a V-shaped recovery. So there you go. I mean, tell me if I'm wrong, but that's how it looks to me. Guys, that's going to be it for today. I hope you find it interesting, entertaining, enjoyable even, and if you do, why not subscribe to the channel? If you particularly like this episode, why not give it a thumbs up, and that would be much appreciated. What have I done? Let me get rid of that. Whoops. Okay, that actually should have said thanks for watching at the bottom of the screen, but there you go. A little glimpse into one of the other things that I like to do in my free time. I'm involved with a animal rescue charity, and that's something that I plan to continue, at least at this stage, if and when I am able to I've started to change my rhetoric. I used to say retire early. Now I say if I'm able to leave work early. And the reason I say that is because my plan is not to leave work early and immediately claim a pension, which would obviously come with penalties. My plan is to leave work early, to leave the pension intact, and only claim it when it is due without penalty. That is the hope. I don't think it would be a massive problem either way. If I was to claim it early, I'm pretty sure that things would be fine financially, but it would just be that little bit more fine if I were to leave it alone until full maturation. But anyway, yes, I'm rambling. Listen, thanks for watching. Have a great Wednesday and the rest of your week, and I'll be back next week with more.